Hi there. Thank you for attending and joining the Transitions into Medical Practice. My name is Christian Dye, and I have Gurpreet Mann with me. Today, we're going to be touching on a couple of different topics. I'm going to talk about the top 5 mistakes to avoid when transitioning into a medical practice. Gurpreet is going to talk about incorporating and try to field some commonly asked questions and answers. And then I'll talk a little bit about family management as well, and just to prepare for those people who are planning on starting a family soon. So, a couple questions to answer over here. Should I consider buying a home or just rent during residency? Is it worth it to start paying back my loans? When is the right time to incorporate? And what are some common mistakes that residents make? So, I'm going to jump in with the transitioning and some of the pitfalls to avoid. And I break it down into five different ones. So, mistake number one. What is the greatest determinant of wealth in your first year of practice? And I'm talking about after residency. And I give you a hint, it is not income. So the first mistake that people make is that they will chase income when they should be chasing income ratio. So the greatest determinant of wealth is income ratio. And that's a simple formula. It's the expenses divided by your income. So if I had a physician making $500,000 per year in income, but spending expenses of 499,000, well, it's simple. That person is going to die poor. They're chasing income, but their expenses are too high. If you had someone else making $50,000 a year, but only spending $30,000 a year, then of course they're going to end up much better. So, an income ratio of 60% means that you have 40% of your income to invest or pay back in loans. So the mistake is, of course, chasing income and not income ratio. Now, later on, I'm going to show how you could track what your income ratio is. And this isn't just for residency. This is also, of course, when you start practicing. Mistake number two, deductions. So what percentage of income do unionized professionals automatically deduct? So they're teachers, these are engineers, these are uh, um, nurses. The answer is about 35 to 4%. So the very first paycheck they will ever see, they're going to get a little bit of a sticker shock because they're going to notice that taxes, pension, extended health, and insurance have been taken off. Now, the issue with physicians are that they are paid in gross, not in net. Now, in residency, they do take things off, but once you start practicing, it's all paid in gross. So it's your now responsibility to start shaving off this 30, 35, or 40%, just as if you were part of a company or a union. Because these things are important, especially when you get older. If there was any sort of medical issues with your family, if come retirement, having a pension, and of course, come every tax season, having to pay your tax. So what is about 40% of gross income off of 120,000? Well, that's about 4 grand a month. So what I'm encouraging over here is to sit down with someone to take a look at how much you should be taking off before tax man hits, before retirement hits, before all of the other issues into play. So the mistake is not putting these automatic deductions into place and of course just spending all of that gross income. So this next slide over here, I want you to imagine you're in your very first year of practice and you are offered 2 jobs. Job A pays $150,000 a year, but for your family, if you were to die, you get nothing. If you were to be disabled, you also get nothing. And if you were to be critically ill, you get nothing. Now, job B pays $145,000 per year. If you were to die, your wife and children get $1 million. If you're to be disabled, you get $7,000 per month for the rest of your life. And if you were to be critically ill, you get $200,000. So which job would you take, job A or job B? The majority of people would choose job B. Now, what I want to point out is job A and job B are the exact same job. The only difference is the person in job B has taken $5,000 of their income and has put it towards their insurances, their life insurance, their disability, and their critical illness. So this is the protection of the income. So mistake number 3 is not insuring yourself adequately. So why is it important to put insurance in place now when you're young? Because that, of course, is best time to put it in. As you get older, the rates increase. If you are still in medical school, then you have discounts on your disability insurance, and these discounts, of course, go away once you go into practice, and these discounts stay with you for your entire practice. Your age is getting higher, and inflation is pushing the rates up. And the last one is your health is moving in the wrong direction. And not only your health, but the health of your family members, because that could potentially cause you to also be uninsurable depending on the insurances that you get. So, what I usually say is do an insurance review, take a look at what you need, take a look at what your short term goals are. If you're about to have a family, or if you're about to have kids, or if you're about to buy a home, or at the very least with the disability insurance. So, I always say protect your income and your assets and avoid the Superman syndrome, which of course says that nothing will ever happen to me. Mistake number 4. If you put $1,000 per month towards a retirement investment earning 8% per year, you'll have contributed about $240,000 over 20 years. How much would it be worth? Okay. Here you're looking at a little over half a million. You will have contributed 240 grand and you will have had about 568. Now my next question is, what if you didn't contribute one more penny and you just let it sit for 10 years, still earning 8%? Now what is it going to be worth? 1.2 million. The number doubles just by adding another 10 years, even though you don't make any contributions. To understand this, we take a look at, of course, our old high school formula of compound interest. Now, if you look at the curve, where is all of the growth? It's at the end. It's those last 10 years. And so the mistake that I find is that people will often think about retirement when they're getting closer to retirement. But then, of course, you've lost years. You can't buy back the years. So our next mistake is delaying your investment. If you're young, if you're in your 20s or your early 30s, those are the best years to start even a small amount. And again, you're self-funding your own pension. But I find that if people are coming to me when they're in their 40s and it's now saying, it's time to invest, well, I've got about 25 years left to invest with them. And if I could have squeezed out another 10, I pretty much could have doubled all of their money. So, last one, spending. Now, if I ask you what would you do with $1 million, if you think about it, a lot of people are going to run towards things like, I want to buy a car, I want to buy a fancy, house. But I want you to think of this. The poor are always eager to spend. That's poor thinking. The rich are always eager to invest. And what I'm trying to do is shift the way that people think a little bit. What we want to do is we want to invest and then live off of the rest. A lot of times people, they want to spend and then invest whatever is left over. The problem is there's usually very little left over. So the reason why I show a temperature gauge over here is because a temperature is sort of what our attitude is like. So if the room is at 72 degrees Fahrenheit and if it gets too hot, air conditioner kicks in. It gets too cold, heaters kick in. Same thing with spending. If our temperature gauge is set as a rich thinker and we suddenly don't have money for whatever reason, then we become very conservative because that's the way our thinking is. But if we suddenly have a lot of extra money, we start to invest it because that's the way our thinking is. But if you have poor thinking, well, if I don't have a lot of money, then you start borrowing it so that you have this ability to spend. And when you do have a lot of money, you spend it. So what I'm trying to do is switch people's temperature gauge, get them to control the spending, especially in the early years, put the investments in. You've seen what the numbers look like by putting investments in early. You've seen the advantages of putting insurance in early. Okay. So getting yourself organized, what are some of the ways that I like to help people get organized? I work with UBC Dentistry, UBC Medicine. I work with a lot of young families, and these are some of the ways that I like to do it. I give them my financial planning kit. It's a very, very simple Excel sheet with 3 tabs, and it helps to figure out where you are, where you want to go, and an action plan on how to get there. Just like a business, they measure things in quarters. Okay, so this over here is why I like to send this Excel sheet out. Even for airplanes are off course 99% of the time. They've got a gyroscope to help to keep them on track because they're constantly making minor adjustments just to make sure they land where they're supposed to. So my sheet looks like this. It's an Excel sheet, and it will take in your income, and as residents, of course, you will start to have an income, and then you plug in all of your expenses. Now, the sheet, you only have to plug in the first column, and then it will calculate what your ratios are for how much you're spending on housing, transportation, food. Uh, what the sheet ends up doing is trying to figure out, am I under or over for the year? Will I be in the negative or the positive? And if you've got some big expenses, you'll plug it in and you'll be able to see. Then I talked about income ratio. Income ratio, it calculates it for you so you can get a better understanding. And to remind you once again, what is not taken in expenses and income ratio? Loan payback, any sort of savings, any sort of charity. That is not taken. Everything else is considered an expense. So it's good to see, well, what is my income ratio? If it's too close, like 99%, 95%, things of that sort, you're in a dangerous area. So the second tab on my financial planning kit is the assets and liabilities. You would gather up, what are my loans at, or sorry, what assets do I have, if any? If you have RSPs, or maybe you own a home, or maybe you've got some money stashed away somewhere, or some investment property, you would list it. And then we have our liabilities. I got a $200,000 student loan. I've got more government loans. I got a Visa card. I got car loans. And what you'll notice over here is you assets minus liabilities, you get what your net worth is. Now, of course, if you've got heavy loans, your net worth is obviously going to be negative. But what you want to do is when you start making money is measure each quarter or at least once a year and recalculate to see, are the numbers getting better? Because if the numbers are moving in the wrong direction, even though you're making money, something's got to be wrong. The third tab is my goals. And this one over here starts to calculate, what are my goals? Is it to pay back all my loans in 5 years? Is it to have a down payment on a house within 2 years? Is it to save for retirement? So you list out your goals. Then you would give your current status. Male, age 22, I'm married, I've got I'm an R1 resident, I've got a salary. Because what I help people is when they send this to me, all I do is give them more or less free financial advice. I look at it, I comment on what their next move is. All I'm trying to do is to help them is to say what should be the next strategy. Maybe it is to just put all the money towards loans. Maybe it's to try to get that down payment and minimum fund the loans. But a lot of people are very unsure of what direction they want to move in. And so this is my way of trying to give people a start in the right direction. So what are the greatest uncontrollable monthly expenses for a young family once in place? Kids, housing, cars. You can't control those expenses once they've already been put in place. What are the greatest controllable expenses? Well, you got your food, restaurants, entertainment, vacations. What is the best way to have financial success with these expenses? Always think about your lower income ratio. By lowering the ratio, create a lower ratio with the uncontrollable at the very beginning. So if you could control the housing and the cars, then everything gets easier. The number one reason why income ratios tend to be so high is usually housing. People will buy too much house too early, and then they just have a large mortgage which they have to pay off. I often recommend that people upgrade slowly. Let income catch up, let equity catch up, and usually you don't need such a big place right away anyway. A quick little budget recommendation. These are ratios that I like. I like 35% for housing. I know a lot of people think that that's insane. 35% of your net income should be going to housing as a maximum. And if you do the numbers in Vancouver, you'll think right away that's almost impossible. It's not impossible. All it means is that you won't be able to get what you want right away. You'll either have to move further from the city or get something a little bit smaller. But if that number, 35%, gets pushed too high up, what will go? Ratios means if you're putting more in one basket, you're taking from another. Typically, donations gets thrown right out the door, and then investments and savings. And then all you end up having are debts. Debts towards your food, your transportations, debts towards your loans. So for those of you thinking of buying, I like the number 35%. My tip, if you have no idea what your numbers even are, what your ratios are, put in my Excel sheet all the expenses as a forecast. So you could calculate through the bank, okay, I'm about to buy a place or I'm about to rent a place. Put the numbers in before you've actually made the commitment and see what they're at. I know people who go through this exercise and their housing is at 50% or 50%, and they're wondering why they're working so hard and struggling. These numbers should have been looked at before they even made those purchases. One of the things that I've done is to alter my sheet to actually make it residency specific, so that residents can actually preload their R1 and R2 or R3 salaries, and then it automatically kicks in into income, and taxes are already taken off. So it's made very, very simple. So now what I'm going to do is I'm going to pass this over to Gurpreet, and he's going to enlighten us with his incorporating talk.
Great, thanks, Christian. As Christian mentioned, my name is Gurpreet. I work with MNP, so we're a chartered accounting firm across Canada. A little bit about MNP, if you're not, or if you've never heard of us. We've got 80 offices across Canada. Basically, we like to say that we're pretty much anywhere in Canada that you would want to be. And we work really closely with physicians across the country. So we've got a specialty practice, which I'm a part of, and we focus on the needs of physicians. So some of the areas of expertise when it comes to working with physicians, we do offer low-cost tax returns for med students as well as residents. We're there for helping with the transition to practice, thinking about how you pay yourself once you do enter practice. And then eventually you're going to be exiting practice and thinking about retirement and what all of that looks like. So we've got people at MNP who work with physicians in all of these different categories. For myself, I focus primarily on residents and that transition to practice. I always like to show this slide because it basically outlines the various tax rates in BC. Other provinces are very similar. Tax rate in BC, if you're making over 151,000, is almost 46%. The other provinces pretty much are within plus or minus 3% of that. So depending on what the provincial rates are, these rates do change a little bit by province. In terms of the tax system in Canada, basically, as you increase in income, all of that marginal income gets taxed at a higher rate until you eventually hit the max. So for example, the income that you're earning between 138,000 and 151,000 is only being taxed at 43.7%. And then when you basically get over that 151,000 threshold, then you're being taxed at the higher rate. So one common misconception is that you end up in a higher tax bracket and that all of your income is being taxed at that higher rate. That's not actually true. It's a gradual system. So, that first 37,000 that you earn is only taxed at around 20%. I always get a lot of questions from residents and med students about tuition credits. And common question is, what are tuition credits actually worth? So depending on whatever your tuition credits are, a good rule of thumb, at least in BC, is that for every dollar of tuition credit, you're going to save around 20 cents in tax. And the way it's been set up is tuition credits are just that, they're credits. They basically reduce tax that you would otherwise pay. So in that sense, there's no reason to ever hoard them or not use them because they essentially have a fixed value. So whenever we can use tuition credits, we always do. Anytime you can reduce taxes owing, that's always a good thing. If you do move to another province, the provincial tuition credits essentially carry over, and there's different rules for different provinces. So certain provinces, the tuition credits will carry over one for one. In other provinces, what they end up doing is using your federal tuition credits as the starting point. If you want more information on that, if you plan on moving, feel free to contact me, and then I can let you know how that works. One other thing to point out is that you have to actually make sure you file your tax returns as a student to access your tuition credits. Occasionally I do have students who haven't filed while they were students, and they start residency and they wonder why they're paying so much tax compared to their peers. And usually it's because they weren't filing tax returns as students, so they haven't built up that base of tuition credits. Another common question is moving expenses. So if you do end up moving for residency, uh, typically you can deduct moving expenses. So there are rules around that, and one of the key ones is that you have to be at least 40 kilometers closer to your place of work. For most people, that's not an issue because typically you're moving to another province, you're moving to another city or something like that. In terms of what you can deduct, things like transportation and storage costs, travel, any other specific costs that relate to getting yourself and your belongings to that new location. If you're sure, you can always keep the receipt and then talk to your accountant. If you're working with me, then I can always let you know whether something's deductible or not deductible. In terms of the benefit of the moving expenses, essentially they come off your earnings. So whatever you earn in that first year in your new location, the moving expenses will reduce that income and thus reduce your taxes. So when you do start residency, you're essentially considered an employee. So as an employee, you receive a T4 for your income, and you actually have very limited deductions as an employee. So things like auto expenses and home office and things like that, typically you cannot deduct them as a resident. So I'll get questions around that sometimes. For certain positions, when you're a resident, you may be required to drive your own vehicle. And in those limited circumstances, you actually get a special form, from the employer, basically saying that you're required to drive as part of your job. And in those limited cases, you are able to deduct auto expenses. For most residents, because you've built up this base of tuition credits, you typically don't pay any tax for the first 2 years of residency. So, we do a lot of discount tax returns for residents, and usually what happens is, as Kristen mentioned, when you start working as a resident and you start getting that first paycheck, tax has already been deducted, and you're basically getting that net pay after tax. But because you have your tuition credits, you can actually reduce that tax that's being deducted. And for most people, we do this on the tail end. Basically, you file your tax return for the year. You've paid X amount into tax during the year because it was being taken right off of your paychecks. And then at the end of the year, you receive a big refund. So, if you talk to your peers or talk to people who are, R1, R2, you'll see that typically they get large refunds. And most people have enough tuition credits that they really won't pay any tax that first year or the second year. So it's not uncommon to get refunds, $3,000-$4,000 that first year, $8,000, $9,000, $10,000 the second year. Now, there is a way to reduce those taxes that are being withheld initially. So there's a variety of ways we can do that. Feel free to contact me and we can put that into place. And what ends up happening is that you end up with more money on a monthly basis rather than getting the large refund at the end of the year. So after you completed residency and you're transitioning to practice, there are a few tax traps that people tend to fall in. So one is, as a resident, tax is being withheld in most cases. And what happens is when you transition to practice, you're considered self-employed. And typically there's, this very large increase in income as well. So it's not uncommon to go from a salary of, say, $60,000, $70,000 as a resident to, 150 to 200, somewhere in there in practice. Now, for that first year, CRA doesn't know that you're making that much money. And sometimes what happens is, someone will come to me after that first year, let's say the first 6 months of being in practice, or even the first year following residency, and they're shocked at how much tax they owe. A good rule of thumb is that you want to put aside around 30% of your gross that you're making for taxes, and you always want to be aware of the filing deadlines as well. As a self-employed individual, the filing deadline is actually June 15th, so a little bit different than the April 30th that you might be used to for a personal tax return. One thing to be aware of is that if you do owe taxes, CRA will start charging you interest after April 30th. Other things to be aware of, keeping good records. You always want to keep the receipts. We have templates available at MNP that we provide that help you track your expenses, just to make sure that you're actually, keeping everything that you need should CRA ever ask for it. Now, as I mentioned, when you do transition to practice, you're considered self-employed, and as a self-employed individual, you do have access to a variety of deductions that you wouldn't as an employee or as a resident. So some of these may include auto expenses, home office, and of course, all of your direct business expenses. One example of this might be attending conferences. So there are limitations on how many conferences you can deduct. There's a limit of 2 per year. And again, this is only when you're self-employed. So if you go on any conferences as a resident, unfortunately, you're not going to be able to deduct anything. Other common deductions include meals and entertainment, which are 50% deductible. When it comes to meals and entertainment, you want to make sure that you keep really good records. And what CRA wants to see is they want you to keep track of who you met with and what the purpose of that meeting was. So, if you have a dinner with somebody, what did you discuss and who was at the dinner? Without these details, what occasionally happens, more often than not, is CRA may deny meals and entertainment deductions and expenses. For auto expenses, you need to keep a detailed travel log. So this basically means keeping track of all of your kilometers that you've driven that's work related. So you want to basically track, the starting point, the end point, total kilometers driven, and the purpose of that work trip, essentially. Other things you want to keep track of, your insurance expenses, repairs and maintenance for your vehicle, and if you have an auto loan, the interest that you're paying on the auto loan, and if you've leased a vehicle, then your total lease costs for the vehicle as well. Now, eventually, you're going to get to a point where you start thinking about incorporation. And the main reason people incorporate is basically to defer taxes and then also offer some flexibility around income splitting. For most people, it does not actually make any sense to incorporate once you enter practice. Typically, you still have student loans that you're paying off. You may have other financial needs at that time as well. So one of the key drivers for incorporating is that you're at a point where you don't need to spend all of your income, which really means that you're in a position to actually start saving money. Tied to this is, that you have low or no debt. For most people, if you're still paying off student loans, you're not going to want to incorporate because I'll show you some of the numbers. It just doesn't really make sense. One other consideration is whether you have a low or no income spouse. In those situations, even if you are paying off student debt still, it could be to your advantage to incorporate if you have a low income spouse. Now, one of the advantages to incorporating is the lower business tax rate. So the corporate tax rate in BC is only 13.5% on the first $500,000 of net income. As I mentioned earlier, the highest marginal rate for personal taxes is around 46% in BC. So what ends up happening is if you can keep money within your corporation, you can take advantage of that tax deferral. So rather than paying 46% tax, you're only paying 13.5%. So that's over a 30% deferral of tax, which basically means you have more money available to you to invest and to use for other purposes. A few common myths about incorporation. Some people, they've heard this through friends or colleagues that when you're incorporated, you can actually access more deductions or have more write-offs. It's not actually true. A corporation compared to someone who is self-employed, there's actually no differences in what you can deduct. Anything you can deduct in a corporation, you can also deduct as a self-employed individual. Some of the things that do come into play, though, when you have a corporation is certain tax strategies. So the introduction of a corporation actually creates a new taxable entity that we can use for tax planning purposes and also insurance purposes. things can get a little bit more complex in those situations, and we can, potentially save you money when you do incorporate through, insurance and tax strategies essentially. But when it comes to straight write-offs, there's no difference. One other misconception might be that incorporating can protect you from liability. Not true for a professional corporation. So for a physician, you're still liable for malpractice when you're incorporated. I mentioned earlier that if you don't fall in any of those trigger points when it comes to incorporating, then incorporating early doesn't actually save you any money. So this is just a quick example of somebody who's making $100,000. So the first column is you're making $100,000 and you're incorporated and you're paying yourself all of that as a salary. We've included the incorporation costs and the ongoing costs of the corporation in there as well. And what ends up happening is, you're drawing all of that money out of the corporation for, let's say paying down your student debt. So if you were to pay yourself a salary and you're incorporated, your net cash at the end of the day would roughly be $68,000 on $100,000 of gross income. Compared to being self-employed, that's actually around $3,000 less. Now, if you paid yourself a dividend, the integration of the tax rates is a little bit better, and you end up with an amount that's relatively close to what you would earn as a self-employed individual. But keep in mind, the added complexity and work that's required in maintaining all the, the bookkeeping, the records, etc., for your corporation. It doesn't really make any sense at this stage to be incorporated. Now, let's say, you're making a lot more money, and, as Kristen was talking about, maintaining that income ratio or the expense ratio. So if you're able to actually leave that extra income in the corporation and take advantage of the tax rates in the corporation, then you can actually end up with quite a bit more cash available to you, between your personal cash as well as the corporation's cash account. So in the situation here, you're earning $200,000, but let's say your living expenses haven't really changed, and in terms of what you need to pay the bills, you still only need about $70,000, similar to the previous example. So the first column here, you're incorporated and you're going to pay yourself a salary of $100,000, which basically nets you that $71,000 of personal cash. But because we're basically keeping that money in the corporation, you actually ended up with around $83,000 of extra cash in the corporation for the extra $100,000 that you earned. It's very similar if you pay yourself through dividends. You do end up with a little bit more through dividends. In this particular scenario, we've reduced the dividend to only $85,000, and that's just because of the way salaries are taxed versus how dividends are taxed. At the end of the day, you still end up with the same amount of cash in terms of your personal needs. So in this case, $73,000. And within the corporation, you've got another $84,000. So your total cash in that middle column there is $158,000. Now the last column, let's say you remain self-employed and you can't take advantage of any of these tax deferrals. So what ends up happening is you get taxed on that $200,000 that you earned fully in your personal hands, and you only end up with cash available of $128,000. So just looking at the very bottom row there, by incorporating, you actually end up with roughly $30,000 more of cash available to you. And this essentially is a tax deferral, because if you were to draw all of the money out of the corporation, you'd still end up getting taxed on it in your own hands, and you would only end up with that 128 roughly. But because you don't need all of that money and you're able to save it, then you end up with around $30,000 more than you would have otherwise. And with that extra $30,000, compound that by on a yearly basis essentially, and if you're able to invest it, then obviously you're going to come out far ahead. So this is the main driver of why people incorporate. Essentially, you're able to defer tax by keeping money within the corporation. Now, obviously, the caveat there is you have to keep the money in the corporation. So you can't actually draw it out. The second you draw it out for your personal needs, then you get taxed on it. One other situation to think about is the potential for income splitting. So I mentioned earlier that if you have a low income or no income spouse, then we could utilize income splitting to reduce your tax bill. Uh, Even in that first table that I had where you're earning $100,000 and you're drawing every dollar out because you're paying student debt, you're not really ahead when it comes to incorporation. However, that scenario changes significantly if you have a low-income spouse. So what can be done there is that we can actually split income with the spouse and potentially save taxes. Now, when you do save taxes, income splitting, those are actually true tax savings. It's a little bit different than leaving money in the corporation, which is really a tax deferral. Uh, One analogy I like to use in terms of the tax deferral for incorporating is how RSPs work. Most people are somewhat familiar with how RSPs work. Essentially, you put money in your RSP, you don't get taxed on it, and then eventually take the money out and you do get taxed on it. The idea there being that you're going to, put money away while you're working, and then eventually when you retire, you start drawing on it. And since you have no other source of income, it's being taxed at a lower rate. Within your corporation, it's very similar in terms of the idea. Basically, you're keeping money in the corporation. It's being taxed at that 13.5% in BC. And then eventually when you draw the money out, you get taxed on it personally. Now, for most people, what they're doing is they're saving money within the corporation. That essentially becomes their retirement fund. So over the course of a career, you're actually able to save a significant amount of money in your corporation. And then eventually when you retire, you're able to draw that money out from your corporation. And at that point, in theory, you have no other sources of personal income, and your personal tax rate drops as well. A few other areas where income splitting is important is if you have children. It can be a great way to fund post-secondary education. Essentially, looking at the tax rates today, I can pay or set up a dividend for a client to their adult child who is attending post-secondary school, and we can basically put around $30,000 per year in the child's hands, almost tax-free. And that's usually because those kids who are going to school or in post-secondary school, they have no other source of income because they're attending school full time, and they have some tuition credits as well. So typically this is actually a better way of funding post-secondary education than RESPs or other mechanisms of saving money, primarily because you're actually using corporate money to fund the post-secondary education versus personal money that's already been taxed at those high rates. So in terms of just closing comments, over the course of your career, your number one expense will be taxes. So, we see that, looking at our clients and in terms of the money they make, it's not the mortgage that they're paying, it's not, other expenses. It's almost always the taxes that you pay. That's going to be your number one expense. So, the job of your accountant essentially is reducing that number as much as possible through tax planning, and that's essentially what we do at MNP. I'll pass it to Christian.
That was wonderful, Gurpreet. I think tax is always a big question, and to remind people over here that we will get information at the end again. And by doing that, we're actually inviting people to connect with us if they had any tax questions or financial questions. I just have a few more things that I wanted to touch on, especially for the family planning. You know, with marriage comes babies, with babies comes expenses, and I have a lot of clients who tend to say, "What should I do if I'm still in my residency or I'm still paying off my loans? I have this child." So, which is very, very common. So what you want to do is you want to think over here that for the first 5 years, couples are crippled financially. It's because it's twofold. expenses are going up and income is going down. What I always try to do is try to tell them that, it's like trying to win in a race when you got one leg tied behind your back. Just try to survive those years. Try not to go into any more debt. Try not to dip into your line of credit. Just whatever income that you have, live off of that. Because I think the mistake people make is they say, well, y- you know, income has gone down, expenses has gone up. Well, where am I going to make up that income? I'm going to run towards my line of credit because I still have room on the line of credit, or I'm going to, take out more credit. I think what you want to do is just live off whatever you have. So here, a big tip is what I like to call a stress test. And with my clients, I run a stress test on their income and expenses using my budget sheet, because then I could forecast what will the year that you have a baby look like, what will the next 5 years look like, and can your budget handle that based off of the decisions you're about to make, such as housing. So when I run a stress test, people said, yeah, we've got perfectly good dual income, so we can afford this house. But then I say, if you're planning on having kids, you got to run the simulation off of the stress test to see the years if you're going to be going to the negative or not. And I like to make sure that they make these decisions actually before they have kids or before they buy the home. Uh, After medical school with residency, a question is often asked: should a resident start paying off their student loan? Because of course, technically, they have money. So the answer is it depends. It depends on your situation. So, for example, if you have a family, my answer might be different than if you were a single person. If you were able to find housing locally in Vancouver, living with your family, well, then again, that would be very different than if you had to move somewhere else. So the tip is always start with a budget forecast. If you can paying back your loans, I always recommend it. One of the reasons is because it's a fantastic habit. If even you could put 10% of your residency income towards your student loans to start paying it off, which I have clients who do that, well, that's great, because then they're in the habit of paying money off. They're in the habit of saving, of not overspending. And once their residency finishes, the habit continues and they just start paying it off more aggressively. Housing affordability. So housing is always a hot topic. I actually have a presentation coming up specifically just on housing. And here, especially because of Vancouver's hot market. So for housing affordability, would a medical resident making $50,000 with a spouse making $40,000 qualify for a mortgage if they had $100,000 in line of credit loans? So I talked to my banking partners about this exact question, and this was their answer. Yes, they would. They would actually qualify for about 250 to 375,000 in mortgage. Unfortunately, here in Vancouver, that doesn't buy you a lot, depending on where you're going. Okay, it also depends on your loan payback. But I guess a very quick answer is I think there's this conceived notion that I have to finish my residency before I'll even qualify for a mortgage. Well, it depends. It depends if there's dual income over there. It depends on what your other expenses are. I'm a housing guy. I always have been. I believe that if you could afford housing and it matches the ratios that I like to keep my clients under, I always think to buy. Because there are people who make only $50,000 a year and they afford housing here in the Lower Mainland. So, mortgages, what are some things that the bank wants to look for if you are thinking about it? I always encourage people to pre-approve if you're within 6 months to a year of actually purchasing a place. The reason is because if rates are low, you get the lower rate guaranteed. And if rates go higher, you get the lower rate. If rates go lower, you also get the lower rate. So if you're a stone's throw from purchasing a place, always get pre-approved. I would work with a professional. I got many professionals that I work with that I would love to recommend. So what are some things that can improve your credit score? Okay, because they always take a look at your credit score. First, if you have outstanding debts like credit cards, car payments, things of that sort, always make those payments on time. Late payments always ruin your credit score. Try to keep all balances under 75% of the limit. For example, if you had two line of credits for whatever reason and all of the money was in the one, it actually would be better to keep both of them under 75%. Your credit score looks better. And avoid applying for credit too often. I'll give you a perfect example. When you walk into the Bay and someone says you get 10% off whatever your purchase is if you put it on a Bay credit card, which you're signing up for. Remember, you're applying for credit. When you go to the and no financing until or no payments until 2016, you're applying for credit. Don't apply for credit too often. As a matter of fact, try to avoid it completely, especially if you already have a credit card. So, some finances to do before graduation. Prioritizing to finish medical school, this is the best time to get organized. So, some things to put in place. Number one, loans. Have a good understanding of a strategy of how you're going to pay them back, whether you're going to start in your residency or whether you're going to, and this is my suggestion, aggressively pay them off after residency. Number two is income. Accurate income projections to allocate an appropriate budget. And number three, your insurance. Taking advantage of any insurance company's discounts in disability insurance that you can get. If you're stone's throw away from buying a place or having kids, you should really be looking at not only disability insurance, but also your life or critical illness insurance. It's the best time. Rates are incredibly cheap. So, how are some different ways that Gurpreet and I can give you guys a hand? One way is to discuss any sort of business or financial strategy before you graduate. Like I said, our email address and our cell phone number will be provided. And if anyone wanted to just talk and get some good advice, feel free. My financial planning kit, I recommend this to everyone. Why? It's a gyroscope. It keeps you on track, shows you where your money is going, and it prediction of what your next few years are going to look like. As well, I of course can help with an insurance review if people are trying to still put their disability insurance in place or any sort of life insurance. And through Gurpreet, of course, there's tax planning. And whether it be through email or a phone call or a meeting in person, we could help to put you in the right direction. Okay, we'd like to be part of your team, whether it be now or later. Many of our clients are actually physicians and in the medical field. So we leave this one as a closing slide. It has our contact information. We will try to also send out an evaluation to get more feedback. If you can please fill that out over here. Uh, Inside that feedback or directly through email, you could ask for my financial planning kit, or you could email Gurpreet or phone him if you had any tax questions. But in essence, I wish you guys all the very, very best of luck. I hope that your residency and your practice is off to a good start from a financial perspective. I know your long road ahead is slowly coming to a close. So, once again, thank you for listening, and I hope to hear from you guys soon.